Good afternoon. This is Chris Hattingh back at the CRA Risk Desk on this Wednesday afternoon, the 11th of February. Today I'm going to do a solo discussion. I wanted to share some thoughts around the hype around South Africa's economic turnaround, economic recovery that we've seen in the headlines over the last few months, late 2025, now into 2026. We're going into the State of the Nation address to be delivered by President Ramaphosa on Thursday. My colleague Offense and I will be attending the SONA live, so we're looking forward to that, and also looking forward to seeing exactly what the feeling is on the ground and what we can share in terms of insights and analysis as we attend the SONA. And then I think arguably in many ways more important than the SONA, we have the next main budget set to be delivered later this month by the Minister of Finance, Minister Enoch Godongwana, which will indicate state spending priorities. So behind the rhetoric, where are the priorities going? Because of course the state needs to collect revenue and income, and then we've got the expenditure side. So where does it go? Does it go to things like a basic income grant, national health insurance, expropriation, land reform? Where exactly do the priorities go? One of the top ones is always the public sector wage bill. I think that is set to continue, but let's see exactly how that shakes out. But today, I'm just going to share some thoughts from a recent piece of mine published in Business Day around whether South Africa's economic hype, economic turnaround, is that hype justified? I'm going to share on the screen one particular data point that I'll leave up as I sort of go through this timeline. So in a nutshell, through the second half of 2025 and so far into 2026, something odd has happened. The economic headlines about South Africa have become remarkably positive. This bucks the trend of the previous decade when the headlines reflected South Africa's downward economic and quality of life trajectory. Now, apparently, things are different. The Government of National Unity has held together. After excellent work by the National Treasury and other departments, South Africa was removed from the Financial Action Task Force's grey list relatively quickly. On the economic growth front, GDP growth is forecast in the 1.2% to 1.6% range this year. That would be a tripling of the 2024 growth rate. So take that from whence it comes. It's a tripling of the 2024 growth rate. It is not substantial enough, nearly enough, to shift the needle on unemployment in South Africa. We need our growth rate to be above 4% consistently for the unemployment rate to be seen to be improving in a positive trajectory. But possibly this year, we've got a tripling of our growth rate from 2024. We have the debt to GDP ratio set to, it is on track to stabilize further, and the lights have stayed on. Now, not everywhere. There are still regular power outages across the metros, across many parts of South Africa. Just in the last 2 weeks, we've had the water supply issue really come to a head in places like Melville and Midrand. It shouldn't take these long outages for the government to at least acknowledge the issue and be seen to be taking it seriously. But for all of that, there are some positive indicators, at least on the sentiment front for South Africa. The JSE All Share Index reaches new high after new high, week after week. Now, in this year's 2026 Strategic Intelligence Briefing, which we've titled Pulse of the Nation, we analyzed the key economic polling and political data to make sense of the risks and take advantage of the opportunities in South Africa. So while these positive headlines and market sentiment are not to be sneezed at, I'm not attempting to undercut them, substantial risks remain that could tilt the economy's short time in the recovery ward back into terminal territory. While the slight uptick in growth should be welcomed, it is far from sufficient to meaningfully reduce South Africa's unemployment or raise incomes. That would require a significantly higher growth rate, which is difficult to achieve while gross fixed capital formation as a percentage of GDP remains at half the global average, or between 13 and 15%, when fixed capital formation is hampered by high levels of crime, by political threats to property rights and restrictive regulations, notably race-based regulations. For what I mentioned around the lights being kept on and some seemingly positive work by Eskom, which I don't again want to discount given the situation in which Eskom found itself just very recently. Key network industries such as electricity, ports, and rail remain state-centric and bundled, acting as severe constraints on economic activity. And possibly in the future, risks that could spill over to the entire economy. For example, on the electricity front, should our coal fleet encounter more problems, the coal power stations, should we also reach the gas cliff that industry has warned about in terms of our gas supply from Mozambique, we will encounter load shedding again in the second half of this decade. So while some sectors, such as finance, have done well over the past 12 months, sectors that should absorb more labor and create more jobs, like manufacturing, mining, and construction, are not moving significantly, at least not yet. It is one thing to buy shares on the JSE, but it's quite another to sink tangible capital into the country. The latter would indicate a more substantive and ultimately important signal that investors and businesses are more confident about the country's prospects and willing to take on South African risk. There is a major risk that the positive headlines of the last 12 months will fuel political complacency, removing the urgency to change policies and pieces of legislation that have eroded South Africa's competitiveness and prioritized government consumption expenditure over productive investment. The IMF forecasts that the economy of sub-Saharan Africa will grow by 4.6% this year. However, the South African economy is acting as a significant drag in the region. If we exclude South Africa, sub-Saharan Africa is projected at 5.5%. So with South Africa included, 4.6, remove South Africa, 5.5. That would mark sub-Saharan Africa as the fastest growing region in the world. With the dollar relatively weak and gold recently surging past $5,000 per ounce before consolidating just below that benchmark, some of the numbers in the South African economic and fiscal picture will look better than many will have predicted. However, should these global factors prove to be cyclical, as they have been before, the sugar high and the temporary fixes and reprieves will subside, and the weakness of the South African patient will once again be clear. So now the question is, will South Africa, through the GNU, business and civil society, pursue the kind of reforms, take the necessary and difficult, painful surgery and medicine, or will it seek comfort in feel-good treatments and narratives, popping a few panados every now and then? The GNU, the stability of the GNU does offer a window for reform, but its impact will be limited without addressing anti-growth policies and legislation, as well as structural issues such as basic service delivery. The expectations and ambitions of a young South African population remain unmet. That kind of potential energy cannot remain quiet and unrealized forever. And I'll close just on a little explanation of the graph that I've put up on the screen throughout this discussion. If we look at final consumption expenditure for South Africa from 1993 to 2024, if you look specifically from around 2021 to 2024, how much that has increased again back to the 84% mark, so as a percentage of GDP. I suspect that South Africa's economic turnaround in the last 12 months, a turnaround such as it is, has been driven largely by this kind of spending, especially household spending and household consumption, where we've had a few interest rate cuts. You've got, again, a stronger rand and a relatively weaker dollar, so it's cheaper to import fuel and oil. That has helped in terms of some spending. That is not enough to push South Africa's growth rate to above 3, 4, 5%. For that, you need the real fixed investment rate. You need your capital formation to increase again, and you only get that through the right kind of reforms, ideologically, and in the policy space. And for now, rhetorically, we've seen some of that, but not in substance. So a bit of a warning here that South Africa's growth recently risks being very cyclical and purely consumption based and not investment in infrastructure and capital based. And if household consumption once again is under pressure, as it would be through things like municipal rate increases, price increases by Eskom, by water utilities, by entities that run various supply side factors in the economy, should that household consumption decline again, then our much hoped for growth of 1.2, 1.3, 1.4% will once again decline. So a call here to look past the headlines, as positive as they might be. Let's see if our growth is consistently quarter on quarter, at least 1% or higher, and specifically whether our gross fixed capital formation rate, so the real fixed investment, whether that rate increases from around 15% to 20%, 25% consistently, quarter on quarter, year after year, then one can say South Africa's economic, the hype around South Africa's economic turnaround is justified. And on that note, I'm going to end. Thank you all very much for joining me. Should you have any queries, questions, and if you require more information about the Center for Risk Analysis, we invite you to contact us at the email address in the description below. Until next time, this has been Chris Hattingh at the CRA Risk Desk. Take care.